All right, everyone. We'll get started right now. And thank you, everyone, for joining us. Today, we're going to be talking about the value of a certified public accountant, an estate planning attorney, and a financial advisor. Throughout the different stages of life, this is part 2 of a 4-part series. And today's presentation is geared toward individuals with young families, maybe they have minor children, and newlyweds. So today's webinar is presented by Euri, Donna Lee, and Sophia Kim Sakamoto. Euri is a certified public accountant, and her office is located in Fullerton, California. Donna Lee is a certified financial planner, and her office is located in Orange, California. And me, I'm Sophia Kim Sakamoto. I'm an estate planning, probate, and living trust attorney. And our offices are located in Buena Park and Mission Viejo, California. Just want to remind you that questions are going to be held until the end of the webinar, time permitting. If you do have a question, there is a chat box below where you can type in your question, and then hopefully we can get to them. And if not, you can certainly email us and we'll respond to you after the webinar. Also, the webinar is being recorded, so just so that you're aware of that. I also want to put a disclaimer out there that, of course, this presentation is just general. It's not legal, financial, or tax advice. If you do have specific questions, you need to consult your own attorney, accountant, or advisor. There's no attorney-client relationship established here. And of course, this presentation is copyrighted. All right, so let's get right to it. One of the questions that I think all three of us receive quite frequently, and it's a very important question, especially in the minds of young families and people kind of starting out with having children, or maybe they're just married, is should I pay off my debt, like student loans or credit card debt? Should I save for a house or save for the future? Donna, I know you get this a lot. People want to know, and how would you respond to this when talking with your clients or someone needing financial advice?
This is a great question, and it's actually a very universal question since we all have finite resources, whether it's our time, our finances, or our energy. The answer is to basically you want to save for all of your goals at the same time, but you want to put more emphasis on the one of higher priority. So how do you prioritize your goals? This should be a discussion between you and your financial advisor. So it's interesting, but prioritizing goals is not just a matter of what you think is most important to you. It's a combination of that, plus any insights or advice or comments that your advisor may have. It's important to get advisor input here, even though they are your goals, because that way you have a better sense of how much each goal is going to cost. Some goals can be achieved using tax advantage accounts, so you don't need to save as much. Some goals, maybe there are other means to achieve them. Again, you may not need to save as much. On the other hand, some may have certain assumptions built in, and sometimes those assumptions are inaccurate, and you may actually end up needing to save more than you initially thought. So once you have prioritized those goals, just focus more on the one that's of higher priority, but the important thing is to save for all of them at the same time. This is much more efficient than saving for one thing, buying it, than saving for the next, because you would have missed out on all that time that could have overlapped. So why is time so important? There's a concept called compound interest, where your interest gains on principal plus interest. You're essentially gaining interest on interest. So the longer the time you have to save, the less you actually have to save, and the bigger and faster your account grows. So instead of saving for goal A, reach it in say 5 years, then start saving for goal B 5 years later, it's better to save for both. You may reach goal A in 6 years instead of 5, but you'll be way ahead when you're done with A and focusing on your next goal. You wouldn't be starting all over from scratch. The common issue facing families, especially young families, is a struggle between saving for a child's college education or their own retirement. And there's no universal right answer here, but definitely something to keep in mind is that there are options for college. There's loans, scholarships, grants out there, public and private, needs-based or not. Whereas there's no one who's willing to loan or give money to someone to retire, sit on a beach and watch the waves. So take that into consideration.
Yeah, that's good. And, one of the things I always think about is like, you spend all this time paying off your debt and at the end you're left with zero. So it's good to do all three kind of a little bit at once, like you were saying. All right. So definitely, saving for retirement is so important. But when do you think is a good time to actually go ahead and invest toward retirement?
The answer is now. The earlier you start, the less you actually have to save. This goes back to that compound interest concept I mentioned earlier, but I will actually prove to you why it is best to do it literally right now. So I am a visual learner, so I actually wanted to show you the cost of procrastination. So here is a chart, a table that basically, it's a mathematical table. This has nothing to do with investing. This has nothing to do with like taxes or volatility, nothing. This is purely mathematical. And the interest rate we're using here is a hypothetical 8% every single year, okay? This is just to show for illustration purposes the cost of waiting. So we have person A. They start saving $6,000 a year at the age of 25. Thank you, Sophia. So they only put in 5 years worth. They put in $30,000 total. So here's the ending balance after every year. And Sophia, if you can scroll down to the bottom, I know it's hard to see, but they end up with, at the age of 60, they end up with $413,000. They only put in $30,000. All right, let's look at person B.
Okay.
So person B, they waited 10 years. They did not put anything in for 10 years. And then they started at the age of 35. So here they are, they do $6,000 a year every year. Same thing, it still compounds at 8% a year. But look how much this person has to save. They saved $6,000 a year until they're 49 years old. And if you scroll to the bottom, they end up with about the same, but slightly less. But the key is they spent 3 times as much just to get about the same as person A. So I think this is a very powerful, powerful slide, powerful table to realize that, hey, I would love to be the person that started at age 25 and not 35. But 35 is better than 45, right? So it's always better to start now if you can.
But Donna, don't you get asked the question about what about investing right now in stocks? I mean, there's a pandemic going on that's very unstable. How would you respond to people asking about the current market situation?
Yeah, that is definitely a common question. And the answer is it depends. If you're day trading, then you really do need to look at a variety of factors. The global economy, political issues, weaknesses in certain sectors, interest rates, currencies, there's a lot. But you're also looking at issues that are very specific to a specific security that you're looking to trade. Maybe they have some upcoming big news to share and it's going to have a really big impact on the stock price. So for day traders, timing is everything, okay? And certain times will certainly be better than others. Interestingly enough, even in the exact same time period, it may be better for one company and not another. Okay, so there is no universal good time when you're in day trading because it could be good for one stock but not for the other. However, if you're looking to invest from a financial planning point of view, then the day-to-day or even year-to-year fluctuations will be much less of an issue. So we focus on holistic financial planning. For clients who have goals they want to achieve regardless of what happens, then we're talking about financial planning. So do you want to retire at some point regardless of what happens? That's financial planning. And market timing just doesn't really matter as much. Okay? Retirement is likely the most expensive financial goal for all of us. The goal is to save a large enough nest egg that we can draw off of and not deplete in your lifetime. This amount can range anywhere from $2 to $5 million per couple, depending on when you retire, the length of retirement, and your standard of living. During your working years, you're saving for this large nest egg, and that's what we call the accumulation phase. When you retire and you start living off of this nest egg, it's called the distribution phase. These two phases are very distinct, and managing for them financially are two very different tasks. Accumulation phase's focus is growing that nest egg. We're trying to grow the account size. So during this time, volatility is your friend. During the distribution phase, it's all about managing risk. We want to minimize risk and volatility to not have that nest egg run out of money.
Very good. Euri, as an accountant and from a tax perspective, what type of benefits would there be in investing in retirement right now?
So saving for retirement is a great way to save taxes. Generally, there are two types of retirement plans that most people can choose from. First is an employer retirement plan, like a 401k. These are offered by your employer, or if you're self-employed, you can set one up for yourself, also known as a solo 401k or individual 401k. In 2020, the max you can contribute into a 401k is $19,500 plus an additional $6,500 if you're over 50. The second type of retirement plan is an IRA, or Individual Retirement Arrangement Plan. These are opened by the individual, which is yourself, through a brokerage or through a financial advisor. In 2020, the max you can contribute into an IRA is $6,500 plus an additional $1,000 if you're over 50. So the amount you can put away through your 401k is much higher than what you can put into an IRA. And many companies offer matching. So they'll do something like, if you put 6% of your salary into your 401k, they'll match half of that and put 3% of your salary into the 401k. This matching is not taxable to you. And so you want to make sure to maximize the matching program that if your company offers one. So those are the two types of plans, employer plans and individual plans. Then there are two types of contribution, pre-tax or post-tax. Pre-tax contributions, which are made to your 401k or IRA, are contributions that you can deduct in the year that you make them. And then in the future, when you retire and take distributions from these accounts, you'll pay tax on the full amount of your distribution, which will include what you put in previously, plus any earnings in that account. So you deduct it when you put it in, and then you pay tax on it when you take it out. Then there are post-tax contributions, which are made to Roth 401k or Roth IRA. Those contributions are not deducted ever. However, when you take distributions in the future, you won't pay any tax on them, not even on any of the earnings. So all of that growth is tax-free. There's not a lot of income out there that doesn't get taxed. So if you go back to Donna's example about compound interest, and you saw that table, and you can think of all of that growth over 30, 35 years being completely tax-free, and that's a lot of money. But not, I'm sorry, yeah. But not everyone can contribute to a Roth 401k or Roth IRA. For Roth 401ks, your employer has to offer this option, and some don't. And for Roth IRA, there are income limitations, meaning if you make over a certain amount of money, you are not allowed to contribute to it. In 2020, the income limits are $139,000 for a single filer and $206,000 for joint filers. If you're managing your Roth IRA yourself, you want to be very aware of these income limitations because there are penalties if you make contributions to a Roth when you're not eligible to. That's why I always highly recommend working with a financial advisor, because they will walk your hand, they will hold your hand through this stuff. Otherwise, I will be left cleaning up your mess.
That is very
the option. If you have the option to contribute to a Roth, it's definitely something to consider. But even if you can't, maxing out your deductible retirement contributions are a great way to save taxes and save for retirement.
One thing I will note is all of the numbers that Euri mentioned, they all change every year based on the IRS guidelines. So whatever number you hear, it's best to double check because it changes every year. It always changes by a couple of thousand. And I will say, going back to the Roth IRA and the income limits, if you go over the income limits, there are some things that we have to do, and it's best to do that before the tax filing deadline. So be very aware of that. The maximum for this year, 2020, is $6,000 is the most you can contribute into a Roth IRA, an extra $1,000 if you are over the age of 50.
Wow. All right. So a lot of good information, and, you know, definitely best to save now for retirement because of that compounding interest and because of all those tax benefits. But I know something that's a lot on people's minds right now, especially with the low interest rates that everyone's been hearing about, is they also want to buy a house as a primary residence. That's been happening a lot. Donna, what do you think about buying property, a place to live, a home, versus renting?
For most individuals, it is better to purchase a primary resident than to rent forever. Aside from the tax benefits of being a homeowner, you have much more control over the cost of a home. Plus, at some point, you will actually be done paying for the home. So, but I will note that while that is often true, it's not necessarily always true that buying is better than renting. So it's something that is best to consult with an advisor or a CPA.
Okay, but taking into account the low interest rates right now, I know a lot of people are asking, well, how much of a house can I afford? What's the limit? Like, you know, what do you say to that?
That is a great question. So this question, how much house can I afford, is a good exercise to run through with your financial advisor. It'll give you a better idea of the price range you should be looking at and the expenses that you should be expecting. So I'm going to go through this calculation. It's a little bit technical, but it just kind of gives you a general idea of how people come up with these. So most lenders will use a percentage of your income to determine the size of the loan that they are comfortable loaning you. That is typically around 28%. So if you take your annual gross income, multiply by 28%, that is the annual amount you should spend on your mortgage, property tax, and insurance. Subtract that property tax out, which is roughly 1% of your home value. Subtract out the insurance, which is usually between $1,000 to $2,000 a year. And then whatever is left, divide that by 12, and that is your maximum monthly mortgage. Now use a financial calculator to see what the maximum loan you can get while not exceeding that maximum monthly mortgage. This is where having a lower interest rate will help, because the lower your interest rate, the bigger the loan you can get. Once you figure out that max loan amount, anything above that is what you need to put down as a down payment for the home. So your house affordability, it is the max loan amount that the lender will loan you plus your down pay. One thing to note is that if your down payment is less than 20% of the value of the house, then there is an additional cost, PMI, private mortgage insurance. There are ways around that, but it comes with higher costs, so not sure if it's really worth it. Ideally, you want to have at least 20% of the down payment for your home, and then we don't even have to worry about that issue altogether.
All right, very good. And Euri, I know you can, you have some explanation or some benefits tax-wise about owning a home. Can you explain a little bit more about that?
Sure. So we'll start with principal residences. Principal residence is your main home where you usually live most of the time. There are several tax benefits to owning a principal residence. First is the mortgage interest deduction. This is a deduction of the interest portion of your mortgage payment. Then there's the property tax deduction, which is either, sometimes it's included with your monthly mortgage payment to your lender, or you might pay it directly to the county twice a year. Both of these deductions may be limited depending on your tax situation. So if you're thinking about buying a home and you're counting on those tax deductions, you may need to run the numbers to see if it would really reduce your taxes. Because of the way tax laws are enacted and expire all the time, it's possible that those limitations that are in place right now will be lifted in about 5 years. And so at that time, then you'll be able to, your deductions will increase. Another tax benefit to owning a principal residence is the Section 121 exclusion. So if you're selling a principal residence that has increased in value, you can exclude up to $250,000 of the gain. That's the difference between the purchase price and the sales price. So you can exclude $250,000 if you've lived in it for 2 out of the last 5 years. For married people, the exclusion is $500,000. So if you and your spouse bought a house 3 years ago for $300,000, and then you sell it today for $800,000, you would not pay tax on that $500,000 of gain as long as you meet all the requirements. So Section 121 is great because it's an exclusion, meaning that you will never have to pay tax on that gain. And it obviously only applies to principal residences. So while we're on the subject, Sophia, when purchasing a home, how should it be titled?
Yeah, from an estate planning perspective, that's a really good subject to talk about, because families always come to me and they have a house and maybe they have, a family or kids. And from an estate planning standpoint, that I do recommend that the title of the house be put in a living trust. And the reason why is because typically if, say husband and wife, they own a property and it's joint tenants, when one spouse passes, it goes to the other. It doesn't go to probate court at that point. But if both spouses go, or maybe the second spouse, they never did anything and now they pass away, and then it's like, well, where does this property go? It will go through probate court if that value is over $166,000 in California. So, and of course in California, probate court takes a long time. It's very expensive. A living trust holding that title, something happens to the owners, then the trust will take care of that outside of court. And so that's why a living trust would be very important to hold title in real property. People always ask me, okay, besides a living trust, what do you say about joint tenancy versus something called tenants in common versus community property with rights of survivorship? How should vesting or how should the title be held? If you have a question, it's very specific to your goals. And you can always contact our office if you have a question about that. Really depends on your situation. How is joint tenancy different than community property? Well, you can have something in joint with like someone who's not your spouse. You could have it with your parents. You could have it with, someone not related to you. And so there is going to be that difference in what that property means, what happens at death, depending on how it's held. I also want to say something about another tax benefit, a property tax benefit of owning real property that's your primary residence. There is a very small property tax exemption. It's called the homeowner's exemption that could also help to lower your property taxes. Let's see. Euri, I want to throw it back to you then, because we've been talking about primary residence, but I see a trend right now where because of those low interest rates, maybe people are converting their primary into a rental and then purchasing a new house for their own primary. What do you think from a tax perspective about some of those consequences and things to think about?
Yeah, so that's very common when people are ready to upgrade their home, and maybe they want to try to keep their previous, starter home as a rental. So remember we talked about the Section 121 exclusion, where you don't have to pay tax on the gain on the sale of your home, as long as you've lived in it 2 out of the last 5 years. As soon as you move out, that clock starts ticking. And assuming you lived in the house for 2 consecutive years before moving out, you now have 3 years to decide whether to sell the house and exclude the gain or to keep the property as a rental. I want to briefly mention 1031 exchanges. This is where if you sell your investment property and use that money to purchase another investment property of equal or greater value, you don't have to pay tax on the sale. However, 1031 exchanges are just a deferral of tax. It's not an exclusion of tax. So if you ever sell that second property and you don't purchase another property and you want to keep the cash, you'll then have to pay tax on that was deferred from the first sale and any tax from the second sale. So 1031 exchanges are super complicated, but I just wanted to mention it to show what the difference is between a 1031 exchange and a 121 exclusion. There are some situations where you can actually use both. So, and that could save you a lot of taxes as well. So if you ever find yourself considering a 1031 exchange, please make sure to consult with a CPA or an accountant before you even start the process.
Yeah.
Okay.
There are deadlines
yeah.
for this. I think there's time frames that certain things have to be done. So it is important to consult with your CPA prior to actually starting the 1031 process.
Yes, definitely. Okay.
What about, should I even buy a rental? You know, Donna, is that something that you can help maybe think about with your clients if they're even thinking about rental property as an investment?
Yeah, absolutely. We take a look at your financial situation and what your goals are. Something to keep in mind with having a rental property is a lot of times people think of rental properties as passive income, which may or may not be true. But there's two parts to having an investment property. There's the income portion, and then there's the appreciation portion. So are you looking for appreciation when you sell it, when you're looking to flip the property? Or are you looking for a passive stream of income that the renters pay you every single month? And so we will take a look at current interest rates and the amount of down payment or equity you need to have in that house to generate that monthly payment and see how it compares to other investment options to see if it's something that is viable.
Okay, great. And when I see clients and they have investment property, one of the good questions that they ask me is, how should that property be titled? Should it be put in an LLC or maybe another entity? From a legal standpoint, there is liability to consider. Of course, if you have other people living in that property, what if they slip and fall? What if they sue you? Things to consider is that investment is part of your estate, part of the assets that you own. So if something happens in that rental, of course, your entire assets are exposed. I do recommend having high limits of insurance to cover that. But keep in mind, whatever insurance doesn't cover, or if it's over policy limits, then again, you're at risk for all your assets to be vulnerable to that suit. That's why people sometimes put these investments into an LLC as a part of asset protection, because if something happens in the investment property, it stays within that LLC and it's shielded against your own personal assets. There are some property taxes to consider. If you have an LLC and you want to transfer property in and out of that LLC, you want to also think about county property taxes and any potential reassessment from that deed. What about from a tax perspective? Because I know people get that a lot. Euri, is there any tax benefits or to having an LLC or think tax reasons to have an LLC or not? Can you talk with that?
No, there are no tax benefits to having an LLC. I'll get that question a lot where people will ask, oh, if I open an LLC, I heard you can deduct more expenses. No, that is not true. Whether you have an LLC or whether you don't, your deductibility of expenses does not change. This applies to rentals, this applies to businesses, and so forth. The side gig, consulting, whatever you want to do. So tax is not really the reason to organize an LLC. I always push it to like the legal side. Legally, will it help you? Do you need that protection and stuff like that? And you also have to know that in California, as soon as you organize an LLC, within 2.5 months, you're going to have to make an $800 tax payment to California every year until the end of time, until you shut it down. And this is even if the LLC has zero activity and you just open it up because you're thinking about it. So if you are thinking about opening up an LLC, make sure that you talk to an accountant or an attorney or someone that can kind of advise you to make sure it's the right decision for you.
Would it be fair to say that if they're just buying one, if they only have one investment property, just one, and they just have really, it's just easier probably just to have really high limits of insurance on that property. If they end up making a business out of it and they have apartment buildings and multi-tenants and 3 or 4 different properties, or properties out of state, or owning an investment property with somebody else, that's really when you really want to consider an LLC at that point. Is that fair to say?
I would say so. For me, if anyone is owning something with someone else, whether it's a rental property or a business or anything like that, at that point it is important to have an LLC or incorporate or something like that, not just for tax reasons, but mainly for legal reasons.
Yeah, and depending on your situation and circumstances, you can also hold an LLC as a trustee of your trust. So that's also something to consider when starting, or if you already have an existing LLC. All right, so besides real estate, if I wanted to save for college, what do you think would be some of the options for saving for my child's college? Donna, what do you think about that?
Yes, yes. Let's bring it back to young families. There are definitely a few different types of accounts you can open for your kids' college. The first is just a regular good old investment account. There are no special tax benefits, but you as the parent have complete control and flexibility on how you want to use those funds. So you can use it to save for college, or a couple years down the road, you decide your house needs remodeling and you use that. So there's complete flexibility in that. You can also use a UTMA or a UGMA account. This is slightly more restricted in that the account is opened in the name of the child, usually a minor. The funds in that account belong to the child and must be used for the benefit of the child. For example, college education, or it could be the shoes that they just outgrew. So you can see that there is a little bit of flexibility there, but it does have to be used for the child. It cannot be used for your home remodeling in a couple of years. When the child is a minor, there is a custodian on the account. When the child reaches the age of majority, then they can transfer the ownership to themselves. There is flexibility in how the funds are used, but the biggest concern parents have is once their kid becomes an adult, they have zero control over how the child uses those funds. Macaulay Culkin story is usually what comes to mind. The other two options are specific accounts for education. This means that there will be penalties if it's not used for education. Tax-wise, they work similarly to a Roth IRA where the funds are contributed post-tax. You do not get a tax deduction, but then when you take out the funds for qualified expenses, they can be done tax-free. The first option is called a Coverdell Education Savings Account, Coverdell ESA. These plans have an annual contribution limit of $2,000, and it is limited by your income. Because of these two reasons, these types of plans, Coverdell plans, are not very popular, especially in California. However, they can be used for private K through 12 schools. The other plan is called a 529 plan. These are designed for higher education, as in after high school. But recent legislation has allowed it for limited K through 12 private school use. There is no annual contribution limit, nor income eligibility. Anyone can contribute into the 529. So this is the perfect place to deposit Christmas or birthday money. 529s typically will have a lifetime contribution limit, but it's usually so high that it's not an issue. And it depends on where you open the 529, but they're usually in the ranges of like 250,000, 350,000. So it's usually not really an issue. People will hear about various states' 529 plans and wonder what the difference is. Does it really matter what state your plan is in? Generally, no. You can live in California, open an account with Arizona's 529, and by the time your child reaches college age, they attend school in Connecticut. So it doesn't really matter. There can be slight advantages of certain states over others, though. For example, some states will allow for a state tax deduction if you contribute into that state's 529 plan and you are a resident of that state. So generally, it doesn't matter what state plan you choose, but there can be some slight nuances that may or may not pertain to you. So talk to your advisor about that.
Donna, quick question. Are any of the options that you listed, do they affect the child's financial aid?
Good question. The answer is yes, especially if the account is in the child's name. So of the 4 that I listed, the only one that is in the child's name is the UTMA-UGMA account. So it will be considered as the child's asset, and it is definitely looked upon heavier than when it's parental assets. The other 3 that I mentioned, the Coverdell, the 529, as well as your own, the parent's individual investment account or joint account, those are considered parental assets. They are still looked upon when they're making calculations on financial aid eligibility, but it's just not as much.
Okay, thanks. All right, so you know, in the same line of saving for kids' colleges, then people always also ask, well, who's going to take care of my kids if something happens to me? Of course, that's a very good concern, something that's on parents' minds. And this is where I talk about estate planning and naming of guardianships for minors. So important to list who the guardians will be for the child, who the parents would want if something were to happen to mom and dad. And the courts, the guardianship court will take a lot of weight into who the parents would want in that situation. You know, this is important if, you know, something happens to mom and dad and, you know, all the family is disagreeing about who's going to take over to be the guardian for minors, and the court will consider what the parents had to say. Who did they want to be the guardian? So that will also be very good. Another thing is to consider is that when mom and dad are not here, kids get the inheritance. They will get the assets in mom and dad's estate, but they're little, they're under 18. How are they going to manage? And even if they're over 18, maybe they're not financially mature enough to handle this estate. What if they blow through all the funds at 18? So an estate plan, a living trust, is a good way for the minors to take care, to have this money available for them. Someone else is already listed to manage these assets for the benefit of the minor until they reach certain ages. And 2, if they're already over 18, what if you don't want the child to have all these assets all at once? The living trust can also say, all right, maybe like a third of the inheritance at 20, maybe the next at 25, and then the rest at 30 to kind of space it out. But even before then, if the child does need it for health, education, maintenance, or support, that the trustee can use those funds to pay the school directly for the tuition, pay the hospital for medical invoices. Also really important to have a trust if you have a child with special needs or a disability, and maybe you're receiving government benefits. And to go to your point, Donna, about the UTMA account, is if you are receiving government benefits and maybe you, you know, obviously the child's not working, they're not going to have assets, but if you had set up an UTMA account, or maybe they're getting a large inheritance, now there's a lot of money in the child's name and the government benefits could be cut off because they're going to say, well, hey, this child has money now. A special needs trust is sometimes established at that point, so that the inheritance funds supplement and do not supersede or replace those government benefits. So sometimes a special needs trust is going to be very important if you have children with disabilities who are getting government benefits. Having said that, Donna, I know that life insurance is also a very good planning technique to take care of kids. Can you explain about generally how life insurance works and why that's important?
Yeah, most people don't think of life insurance as part of financial planning, but in reality, it's actually the cornerstone of your entire financial plan. After all, what good is saving for the future if your foundation isn't even secure? So life insurance is necessary when you have people who depend on your income. This could be minor children, adult children in some cases, or even parents. Life insurance is a contract between you and the insurance company. If you pass away while you have a policy in place, your beneficiary will receive the death benefit completely income tax free. That's huge. The natural question is, how much insurance do I need? There's a few schools of thought, but being a financial planner, where our focus is to realize your financial goals over the next 20 plus years, we generally determine that amount by using a replacement of income calculation. If you weren't around to provide for your family, your beneficiary will need a lump sum of money to draw off of and act as if you were still around to provide for your family. This calculation usually comes out to be roughly about 7 to 10 times your gross annual income. Sometimes you can get life insurance through your employer, but if not, you can always purchase it on your own. Just keep in mind that whatever you get through your employer will usually end when you change jobs or retire. Therefore, I would consider getting the bulk of your insurance needs covered outside of your work. There are a couple of different types of life insurance. We won't have to go into the details here, but at the very least, it doesn't even matter which type you get. You do need something just to cover these what ifs.
Great. And you set up everything, you do your life insurance, but it's all going to be for naught if you don't name the beneficiaries correctly. So a common mistake I see is that parents will name their minor child under 18 as beneficiaries of these life insurances. While God forbid something happens to mom and dad, now the money goes and it's payable to someone who's under 18. Well, obviously they can't sign anything. They don't have any legal capacity to, sign things and hold money. That's when a guardianship would likely be established, and the court holds those funds for the benefit of the child until they reach age 18. Whereas if you had named a trust as maybe the beneficiary of those life insurance proceeds, something happens to mom and dad, the money goes right into the trust, and then we've set it up how that money will be used to take care of minors. So life insurance, living trusts, very critical for your financial foundation. All right, so I think that was the end of the questions and presentation that we had. I don't see any questions. If you do, feel free to type it in the chat box, but if not, then feel free to email us and then we can respond to you outside of the webinar.
There are actually 2 questions that I think we can answer pretty quickly.
Oh, I'm sorry, I didn't see that.
Yeah, I think they just come straight to me. I don't know why.
Okay.
So one is, what about a 403B? Can you contribute both the max $19,500 to a 403B and a 401k?
The answer is no. $19,500 is for the total. What's interesting, however, is if you had a 457B and you have a 401k, you could double dip and do $19,500 in both, which is very unique for clients that are maybe working for the city or the county.
Yes, I just had a client who had that last year and it blew my mind. I had no idea those even existed.
My husband, he works for the county, so he's
crazy.
able, that's how I learned about it. It's amazing, but only that. Everything else, all the letters and all the 40s, whatever, 401k, 401a, 403b, 401k, for all those, you're limited to $19,500. It's only the 457B that they get a separate $19,500, and it has to do with whether it's a qualified plan or a ERISA plan.
Euri, I think we just have one more minute. Is that a quick question?
Yes, they said, how do you know if a Roth 401k is better than a traditional 401k if both are offered? I would say Roth 401k is always better. Unless you just really don't want to pay taxes today, then I guess traditional 401k is okay as well. But at least do one.
Talk to your financial advisor. It really depends on your situation, but I am definitely very pro Roth for clients of a certain age or of a certain income, just because tax rates are, call me cynical, they're probably going up. They just spent.
They're very low right now.
Yes. So it's problem. I mean, talk to a CPA or an advisor and they can break it down for you. But I would generally strongly argue for a Roth plan if you're of a certain age and of a certain income. So let's wrap it up. We are very thankful for your time. As usual, we strive to provide content that's worthy of your time. Our next event will be part 3 in the series, Financial Advice Throughout the Years. It'll be on Friday, September 18th at 12 o'clock. We will still have the 3 of us as panelists, and we will be discussing the next chapter in life, building wealth. It'll be geared towards families with older children or those who have increasingly clear financial goals, and they're working towards building and maintaining wealth while minimizing taxes. We post all of our events on Facebook and on our website. So as usual, please feel free to invite your friends to join us. The more, the merrier. We will be sending out a survey shortly, so please respond so we know what improvements we can make. We hope everyone stays safe and healthy. Have a great weekend. Thank you.
Thank you, everyone. Bye-bye.